Today, I'm going to show you the 5 best moving average strategies that have mathematically proven to beat buy and hold. So, if you are looking for a way to get ahead of the market, to get ahead of everybody else, this is the video for you. So let's watch this together. 5 best moving average strategies that beat buy and hold. And the book that he's going to review is actually from my friend Steve Burns, who's one of my incredible mentors that has changed my entire life. So I'm excited to watch this with you together. And we're going to be playing Big Money Bingo. So the only way you can win Big Money Bingo is putting hashtag outlier in the chat. That way you can win. So let's watch this together.
To all subscribers, welcome back. And for those new to the channel, please consider subscribing, and for those that find value, please hit the like button. Today we look at the book 5 Moving Average Signals That Beat Buy and Hold. We take a ride through the research and back-tested results using the 20, 50, 100, 200 and 250-day moving averages, including crossover combinations. The book
Okay, we are off to a great start. By the way, as we go through, let me know if you see anything like right here is B2, price over any moving average. There you go. There you go. We've already got it on the board.
Demonstrates that by using a systematic approach, you will know when to be in the market or when to get out of the market and cash in before a market downturn. The question is posed, can you beat buy and hold? The efficient market hypothesis would have you believe that all known data is reflected in current asset prices, and it is therefore impossible to beat them.
Hey, Chris, we'll make it way easier on you for you, my friend. If you see entry and exit signals, just type G4 in the chat. Did I miss G4 already? Either way, if I missed G4, tell me in the chat.
Market. Conversely, traders like myself and other gurus covered on this channel know the market can be beaten, and the moving average indicator is just one of the tools we can use to do it. The book uses the S&P 500 or SPY ETF as the benchmark when comparing the moving averages.
All right, fine. You guys are putting G4 in the chat. I'll give you G4. I'll give you G4. Entry and exit signals. Outstanding. Okay, I did see somebody who, David, I watched a Mark Minervini video last week, one of my mentors, okay, reiterated what Chris has been telling us since day one. Yeah, pretty cool, right? And I don't charge $1,000 a month to tell you that either. Everything is live out here on YouTube. Everything will be free out in Outlier University. Wait, did somebody mention Outlier University?
Are you ready? Let's go!
Respect is earned. Respect is never given.
That's right. We are right in the middle. We are in week 2 of Outlier University, where I am teaching you literally everything there is to know about trading. And there is no additional cost to this. If you're an outlier, you get to watch it for free. If you're not an outlier yet, it's only 82 cents a day. Come on. If you're not an outlier yet, it will be on YouTube forever for free, the replay of it. So we are giving away everything. There is no masterclass to sign up for the $12,000 program. No. We give you everything you need, including Outlier University, because we want you to be successful, right? Our success is determined on your success, which is why we want you to be as successful as possible. So anyway, back to the video.
The first to be covered is the 200-day moving average, described as the most popular and used by the likes of market wizard Paul Tudor Jones. In this study, we use daily stock prices and the crossing of the 200-day moving average to determine our position. The back-tested results are produced from the year 2000 through to 2016 and capture bull, bear, and sideways moving markets. A signal should only be acted upon once per month, at the end of each month.
Okay, we already got entry and exit signals. Now, I remember talking to Steve specifically about this signal. In fact, I would bet you that if you go to my YouTube channel, you'll see me interviewing Steve on this particular book. I'm pretty sure that exists. So I remember having that conversation with Steve right there. And I was like, Steve, is it really just once a month? And he's like, yeah. A lot of people don't want to do any sort of work, right? So this is a once per month signal. Crazy, right?
Therefore, a maximum of 12 trades could be generated per year. To enter a long position, we need to see price cross above the 200-day moving average, which we see here, although we need to wait until the end of the month to confirm and place a trade. The end of the month approaches, and we confirm our long position and enter a trade. We then sit and wait out the whole month to determine our next trade decision. Notice how price could drop below the 200-day moving average but remain above it at the end of the month.
I think this is a really important point that I want you guys to always remember is that when you are trading, when you come across a trend that's starting, just because it's starting doesn't mean that it will go on forever. I want to use Tesla as an example. I was using this last week and I feel like this is a really good example. Our job is to find these big, beautiful stage 2 uptrends, right? This right here. Okay. So there are times where it crosses over and then crosses right back under. Okay. Our job is to recognize when it crosses over and then run that dude as far as it possibly can. But there are times where you might make a buck like over here, or you might lose a buck over here. Okay. But you got to be okay with that. You've got to be okay with the fact that sometimes it's just not going to work. Like right here. You've got to be okay that sometimes it's just not going to work. But then when it does work, you are there already and you let it run and you don't get in the way and you don't take your profits early. And so going to a trading psychology aspect of this, right? People can understand, oh, I get my crossover, I got to get in. Oh man, I don't want to take an exit right here because what if it turns around and goes up? It totally could. But we don't know if it turns around and goes up or if it goes turns down and it continues going down. But if it does turn around and go up, how many times, put it in the chat if this has happened to you, because it happened to me a lot. How many times have you put on a beautiful trade and it's working and you're like, oh, I made like 10 bucks on this. I got to take it off right away. I don't want I'm scared of my gains evaporating. Put a number 1 in the chat if that's happened to you. And then what happens is that it runs like crazy. It runs like crazy, but you weren't there. You weren't there because you took your $10 gain off the table because you were used to this, right? Sometimes you're going to make a buck or lose a buck, and it's okay. But when the big trends come, you can't jump off because this big trend will pay for 6, 8, 10, 12 trades beforehand. Stocky Locky. That's a deep cut right there. That one cuts me deep, my friend. You know why that one cuts me deep? Is first, it's a quote from my mentor, Steve Burns, who we're talking about in this video. And he literally said that to me. He said, I used to trade that way too, Chris, but then I realized I wanted to make money. Thanks a lot, Stocky Locky. I love it when you guys burn me with my own words. I appreciate that.
In this situation, we would hold on to our long position and therefore leave the trade alone.
Okay, remember, like you just said, in this situation, we would hold on to it and leave the trade alone, meaning if it's working, you don't touch it. You wait in the trade as long as it takes, just like you'd wait in cash as long as it takes. We're all good. We're all good, dude. We're all good. Hang on, I see some G3, I3, N1. Don't get ahead of ourselves. Don't worry. There's going to be bingos today. There will definitely be some winners here, but only if you put #outlier in the chat. Only if you put #outlier in the chat. Don't take a risk. Go ahead and do it again, just to be safe.
The price continued and closed below the 200-day moving average at the end of the next month, we would sell our position and remain in cash, whilst waiting for the end of the next month to see if price crossed and remained above the 200-day moving average, at which point we would re-enter a long position. The back-tested results of this simple moving average index tracking strategy against a buy and hold strategy are remarkable.
Yeah, and like I say, I'm confident that I talked about this with Steve on my YouTube channel because I could not believe the results with monthly signals. Nothing else than price being over the 200-day at the end of the month. That's it.
If we bought the S&P 500 index in 2000 and simply held it until 2016, we would have seen a total gain of 125.2%, accompanied by a maximum drawdown of 55.2%. If, however, we followed the 200-day moving average strategy over the same period, we would have seen a return of 317.7%, with a maximum drawdown of just 17.3%.
What a difference. What a huge difference here. 125% versus 300%. And then the drawdown, right? This is the part where you're holding on to a losing trade that's not working. 55% drawdown versus only a 17% drawdown. Now, most people, trust me, I've heard it over and over and over again. And last week again, most people can't even most people can't even handle a 1% drawdown. Good gravy. If you had a 55% drawdown, there's no way that you'd be handling it and following that same strategy. You'd be like, this thing is broken. I can't ever make money with this.
In effect, tripling the returns of buy and hold, whilst reducing the drawdowns by more than 2/3. In essence, a rather simple but effective trend-following strategy. Next, we have the 250-day moving average, using the same S&P 500 index as the benchmark. The signal to buy for this strategy is when price crosses and closes above the 250-day average, and unlike the previous strategy, we do not wait for the end of the month. We wait for the close of the day instead. Once the trade is entered,
I'll give you B1. I'll give you B1, I see. Are there any that I've missed? And be honest, because I know you guys like to throw things out there and be like, oh, yeah, he totally said let winners run. He totally said don't buy the dip. Right, Chris? Right? No. If I missed one, put it in the chat. But be honest here. We're all outliers.
we watch the price either continue its trajectory or cross back below the moving average line. If at the end of any given day price closes below the line, we close our position. Due to the requirement of reacting to daily price movement, there is the possibility of creating multiple false signals.
All right, fine. Vaclav, I know Vaclav's going to be honest here. I don't know about the rest of you jokers. He says G3 and I5. G3 and I5. I'll give you those.
Like the previous strategy, which required a reaction only once per month. There are, however,
Alberton says, I only understand the Texan accent. I don't understand what financial wisdom's saying. No, Rick, he didn't. But I appreciate trying. I appreciate you trying.
pros and cons to reacting faster. Clearly, numerous false signals add to our trading costs, but these are often compensated by the reducing impact of a significant drawdown.
Okay, again. So hang on, let's move this hand out of the way.
And cons to reacting faster. Clearly, numerous false signals add to our trading costs.
Okay, false signals to trading costs, right? I wouldn't necessarily say that these are false signals. And the reason I wouldn't say that these are false signals is because you still have the entry signal here, right? It still happens to cross over. But that doesn't mean every time it crosses over, it's going to go to the moon, okay? And that's why I like to say you might make a buck or lose a buck, right? I would never consider that a false signal. Because every time it does this, every time it has that big, beautiful move that we want, it starts with a crossover. Mathematically speaking, every time a big move happens, it starts with a crossover. And because it starts with the crossover, how could that be a false signal? Just saying, how could it be a false signal? If it always does this, then yeah, but it doesn't always do that. But in order for this to happen, it always must cross over. Just my opinion.
But these are often compensated by the reducing impact of a significant drawdown. Ultimately, using a moving average, we can
Hang on. I feel like we could use something here. Cut losses. I'll give you cut losses on that one. I'll give you cut losses.
skew the asymmetric risk versus reward into our favor by minimizing risk and allowing for multiple reward. Arguably,
You said minimize risk. I feel like that's on here. We got a new bingo card today, so I got to double check that I didn't reduce risk. I'll give you reduce risk on that. I'll give you reduce risk right there.
the most important metric in any form of trading or investing. Let us look at the results of this strategy against buy and hold over the same 16-year period. The S&P 500 index achieved a buy and hold return of 127.4%, and the maximum drawdown over the same period was 55.2%. The 250-day moving average strategy returned marginally more than buy and hold, achieving 128%, although the maximum drawdown was cut by more than half, at 23.1%. In theory, this strategy worked.
So this is an important point, okay? Buy and hold, so buying it, never touching it again, versus 250-day moving average, gave you roughly the same returns. However, gave you twice as much sleep. Gave you twice as much sleep because you didn't have to have a 55% drawdown. You only had a 23.1% drawdown. Now, for some people, you'd be like, well, that doesn't mean anything. I'm not making much more money. But while this is going down and you're not taking it all the way down, you could invest it into something else. And that's the important part here, right? This has periods where it's working and then periods where it's flat because you're in cash. Okay.
Works best in a trending bull market, but perhaps more importantly, in a declining market or even a crash, it helps reduce risk.
Boom. He did say reduce risk. We already got reduce risk on there. I will give you another one since he already said reduce risk. Let's do. I'll give you don't buy the dip. Don't buy the dip.
Before we move on, could I please ask you to hit the like button?
I agree. Hit the like button and hit it twice. Hit the like button and hit it twice.
Subscribe and even comment below.
Wait, no, don't hit it twice. Hit it 3 times. 'Cause if you hit it twice, then it goes off. Yeah, 3 times.
It really does help the channel. Next, we have a moving average crossover system, using the 50-day moving average and the 200-day moving average, also known as the gold and death crosses. The trigger to enter a position is determined.
So the golden cross and the death cross. A lot of people love to tell you about, hey, we got a golden cross or we got a death cross. It's over, blah, blah, blah. You can name the crosses whatever you want. I could name the 10 over 20 price over 50. We call it the outlier trend template right now, but we could call it the food station trend, right? Is that on the daily or 4-hour charts? Well, it works on all charts. It works on all charts. It could be the 4-second chart and the 200-minute chart. The reason being is it's just math, right? So to that point, we could call that the food station crossover. We could call it anything we want. So when somebody says death cross or golden cross, a lot of people like lose their shit because somebody's like, oh my gosh, a golden cross or a death cross has happened. I can't tell you how many like social media posts or CNBC articles are written about specifically that, because they have such captivating names. Maybe we need to come up with one, right? Maybe we need to call it the Rex cross. I don't know. It's just maths. The crisscross. No, I'm not taking credit for that. People way smarter than me came up with that.
By the direction of the crossover. For example, if the 50-day moving average crossed below and closed under the 200-day moving average, we would want to be in a cash-only position. If the 50-day moving average crossed above the 200-day moving average, we move from a cash position and buy the index.
Okay, so in this case, I'm going to give you, we already have wait and cash, so I'm going to give you wait for confirmation for that.
Unlike the previous examples, this system relies on the moving average lines only and not the daily price action. Using the same time horizon as before, we can compare buy and hold with this simple 50 and 200-day crossover strategy. From the point of the first crossover signal, buy and hold returned a gain of 167%, with a maximum drawdown of 55.2%. Using the crossover system, we would have generated a 205% return, with a maximum drawdown of 19.2%.
That's great right there, right? And remember, that's over a 16-year time frame.
Considerably less risk than buy and hold. Here we have another popular crossover system, this time using the 20-day and the 200-day moving averages. The same principle as the previous strategy, but with faster buy and sell signal generation. Once again, let us compare buy and hold over the same time frame against this crossover signal. Since the first crossover signal was generated, buy and hold provided a return of 161%, with a maximum drawdown of 55.2%. The simple crossover strategy provided a return of 193%, with a maximum drawdown of 17.3%.
So I want to take a minute just to zoom out just a minute. Let's just zoom out just a second here. He is giving you free alpha. This video is showing you very simple strategies. In this case, it's 2 moving averages. The 20-day daily, I'm sure you could use exponential or simple, crossing over the 200. When that happens, getting in. When the opposite happens, getting out. Bro is giving you free alpha right here, right? And so this came from the book, 5 Best Moving Average Strategies That Beat Buy and Hold by my mentor, Steve Burns. Yet people can't do this. Most people cannot do this, right? They'll try it once. If it doesn't work the one time, oh, it's a scam. Oh, it's so fake. Oh, there's no way to beat buy and hold. Warren Buffett said you should just buy the index and go away. Time in the market's better than timing the market. And like I say, the issue here is that they won't take the sell signal when it comes. Or when it does come, they bury their head in the sand and they're like, oh, not again. But you can have this happen multiple times. And the one time that you just, I'm telling you, this will be exactly what happens to you. The one time that you decide, oh, I'm not going to use this 20 and 200 anymore, it's going to run and it's going to pay for so much. And unfortunately, most people can't do this, right? You need to have consistency and discipline to follow a trading plan. So I'm going to give you consistency and discipline. And I'm also going to give you trade your plan. Where is that? Do I already have trade your plan? let's see. High probability setup, mindset, journal of trades. Okay, I'll give you trade what you see. I'm really trying to give you some bingos over here. Oh, there it is. Trade your plan. Boom, right above it. Ooh, we're getting close to a double bingo looking area right here. That looks pretty exciting.
Again, considerably less risk than a buy and hold strategy alone. Before we check how each system reacted to the 2020 pandemic crash, we look at our final crossover system, this time using the 50-day and the 100-day moving averages. The returns of buy and hold from the point of the first crossover signal accrued to 104%. The maximum drawdown was once again 55.2%.
So in case you're not following along, why is this number staying the same, but this number is not? It's because he's waiting for the first occurrence of this to happen, right? So imagine in his imagine in his data set that this is where it started, okay? He's waiting on it to actually occur right here for it to start. That's why the beginning number is usually different than this drawdown number, because the drawdown number is happening, you know, in the 16 years where it's going up and down, probably happening somewhere right here versus right at the beginning of the data set. So that's why this one's consistent and this one's changing, just in case y'all didn't know.
The crossover system achieved a return of 127% against a maximum drawdown of 19.4%. Again, continuing the theme of minimizing risk. We can summarize each of the moving average systems here. The best
There we go. Check it out. The 200-day crossover, the 250-day crossover, that's just price. And this one was just monthly. Everything else was daily. So your 5200, the 2200, and the 5100, right? Now, huge returns on the 200-day moving average. Once a month system. But the max drawdown on buy and hold was consistent. The return on buy and hold obviously changed because we had different starting points. And you can see just what the, this would be alpha here. You can see how much more alpha you've generated following only this. Now, again, like I say, 90% of people cannot do this one thing. 90% of people could not do this. Once a month, if it's above the 200-day moving average, buy. If it's below the 200-day moving average, sell. That's it. And it's not short sell. It's waiting cash. 90% of people could not do this. But you probably could. You probably could. Yeah, the once a month system did incredible. There's a lot of sitting on your hands. Yeah. And it's funny. So I've been trading for 16 years. And, you know, in my life, I've come across lots of different people who ask, you know, hey, what do you do? And I'm like, I trade stocks. And now, hey, what do you do? I'm a professional YouTuber who trades stocks on YouTube. And they're like, wait, you can trade stocks on YouTube? And they think that like YouTube's the broker. And I'm like, no. I do the trading on YouTube. And I go, oh, that's cool. That must be so fun and exciting. No, really not. If you find trading to be fun, if you find trading to be exciting, you're doing it wrong. As crazy it is to say, if trading is exciting, you've done it wrong. Trading should be boring AF, right? Mr. Ross, the boss, he knows all about that. Trading should be super boring because when you walk in and you are buying a CD, right? Imagine Don, he can imagine. Don's walking into Bank of America and he's like, oh, I need a CD. And they're like, oh, hang on, Mr. Taggart. We got something great for you. We're going to offer you, this is going to be good. You're going to like this. We're going to offer you a CD that's going to earn you 82 cents a day on your investment. And Don Taggart's like, wow, that's incredible. Only 82 cents a day. I can't believe what a fortunate event I am to be put in the situation where over the course of a year, I'm going to earn $299. How incredible. But you know what Don could do with that 82 cents a day? So he could actually go and get OVTLYR, and then he can invest in all kinds of different stocks and have everything basically set up for him using the OVTLYR system. How's that? That was decent, right? But you want to keep dopamine out of your trades. Why don't professional fund managers do it? I think they do. I think they exactly do, which is why we teach this. That's exactly why we teach this. Keep the dopamine out. That's right. Vishal, Chris, I've been just following for 2 days, and I'll be honest, I'm hooked and really ready to learn. Vishal, my dude, I've made 2,500 videos, 2,500 videos at this point. I have given you everything you could possibly need to be successful. All you got to do is make it happen yourself.
Excessive return over a buy and hold strategy was the simple 200-day moving average with an excess return of 192% and a maximum drawdown of 17.3%, making this the most appealing strategy of them all. But how would they have reacted 4 years later, during the 2020 pandemic crash? A buy and hold strategy would have seen a drawdown from peak to trough of 34% between the...
By the way, since he's mentioning this, I'm going to mention it as well. Let's go to SPY. And I want to show you the outlier trend template. I don't want to show anything else on the screen except 3 moving averages. Your 10 EMA, your 20 EMA, and your 50 EMA. That's it. Your 10, 20, 50. Where's 2022, 2020? Okay. So by February 24th, right here, that was your red light. Your 10 was under the 20, price was under the 50. There is no way on God's green earth you should be buying anything right here. But I'm telling you, there were people saying, you got to buy the dip. You got to buy the dip. And then it went down and down and down. So hear me out. This is why I want to show you this, because I feel like this is really impactful. From this point right here, using the outlier trend template, the 10 EMA, the 20 EMA, and the 50 EMA. And I know the question is, well, what time frame? Doesn't matter. It works on all time frames because it's just math. Your 10 period is your short term, your 20 period is your intermediate term, your 50 period is your long term. These are exponentials. You can use it on simples. It doesn't matter. It's just math. Your short term, long term, and intermediate term all working together. Right? From that point to the bottom was about a 32% decline. About a 32% decline. And these people who told you to buy the dip, okay? Buy the dip. I'm a professional YouTuber. You got to buy the dip. Rather than buying it here, why don't you wait for the 10 over 20 price over 50 here on April 20th or April 14th, 2020 here. Now, the reason that I would suggest buying stocks as they're crashing up versus as they're crashing down is because whoever's telling you to buy right here, as the outlier trend template has turned bearish, they had to wait until June. So they went from February to June, 4 months, hoping and praying that the price would come back. And it did. And this is not a normal recovery right here. Okay. They waited 4 months just to get back to break even. However, you waiting for the 10 over 20 price over 50, exit signal, entry signal. That is as easy as it comes. You were up 15%. You were up 15% by the time they got to break even. And you were profitable pretty much immediately while they had to wait 4 months. This is what it takes to be successful. You have to buy stocks as they're crashing up, not as they're crashing down. And you don't have to participate in this down move. Not at all.
The end of February to the end of March. The slowest strategy to react was the 50 and 200-day crossover strategy, enduring the full 34% drawdown. Next, the 50 and 100-day crossover with a 32.5% drawdown. The 20 and 200-day crossover with a 29% drawdown, whilst both the 200 and 250-day moving average strategies endured just a 12.4% drawdown, perhaps reinforcing the 200-day moving average strategy as the most appealing. The author Steve Burns summarizes the analysis by saying,
Steve Burns, my buddy, my friend Steve.
The purpose of these systems is to give entry signals that get you into uptrends and out before strong downtrends. The evidence certainly reinforces his theory and answers the initial question of, can you beat buy and hold? Hopefully, this review has given you...
All right, so answer me this. Type yes in the chat. No. I need you to do this instead. Type #outlier in the chat if you understand you really can beat buy and hold. Type outlier in the chat. Because we're going to get you on the right side of the market cycle when stocks are crashing up versus crashing down. And we're going to make sure that if there is a breakout, that you will absolutely know where to be getting in on this uptrend and where to be getting out on the downtrend. Right now, this doesn't mean that everybody's going to do it, because people can't. People can't, because they don't have the consistency and discipline to see that I just gave you a double bingo. Let's go, baby. But truth be told, here's the deal. I want you to be successful. This video that we just watched right here gives you 5 different 100% free methods to beat, buy, and hold. But 90% of people who watch this cannot do it. They cannot do it because they will panic sell and they will FOMO buy into every opportunity. The difference is between your ears. If you can become mentally a successful trader, this is some woo-woo stuff right here, ready? But it's true. If you can mentally tuck yourself into being, I am a successful trader, I have a successful plan, all I have to do is follow the successful plan, and then the profits will automatically follow, that will make the world of difference. And I love to use this example because I've driven from Dallas to Disney World in my Tesla, which I will never do again, but I wanted to do it just to prove that I could. It was a 24-hour trip each way, and I didn't stop except to charge. The way from Dallas to Disney World has 1 million exits. But if you want to get to the most magical place on earth, there's only one exit that counts. And that's the exit, on whatever for Disney World. Every other exit is the wrong time to exit. And because of that, most people think they need to take an exit here and go to Buc-ee's. They need to take an exit there and go to Wingstop. They need to take an exit here and do whatever. They can't drive the whole way. And here at OVTLYR, we're trying to teach you how to drive the whole way. And the most it's going to cost you is 82 cents a day for the platform. And when we have the platform, we do have a very active Discord. Vishal was asking. We have a very active Discord. And in that Discord, I share all of my trades, and I have for years at this point. And next year, in 2026, we're going to have as many OVTLYRs as possible working to win the US Investing Championship as a team. So I am super stoked about that. And I've only been doing it for 2,500 videos. Yeah, exactly. JG says, OVTLYR is a nearly free fund manager mentorship for me. Yeehaw. Yeehaw, indeed, my friend. Okay, I saved a handful of questions that came through. Let's answer those questions before we do our giveaway here. Chris, are you entering your trades as soon as a buy signal? Is there and supported by OVTLYR 9 and all other metrics, or do you time the entry somehow? So I have, not just I, but we have spent countless hours developing plans M, A, ETF, and sit in cash. Now, there are times where it is time to be aggressive, and we have not been aggressive in months. There are times to be defensive, but being defensive doesn't mean that you're going to win every trade. It's just an opportunity to take advantage of when the market's working for you and getting out of the way if the market has nothing for you, right? And so as far as timing, my dude, that's a lifestyle thing. That's a lifestyle thing, because you could literally sit in front of your screen and be like, okay, here we go, using the 1 minute chart. Here we go. This has got to be the right entry point. Or you can understand that these are meant to be multi-day, potentially multi-week trades. And if you give up a handful of cents by getting in at 253 instead of 953, that's okay. It's not a big deal, right? For me, when I say a lifestyle trade, I'm only looking to trade at the end of the day because that fits my lifestyle. And I want you to come up with a plan that fits your lifestyle. And I'm not going to tell you what that is, right? I don't know your lifestyle. Food Station has a question about this. If I buy 1 to 2 month expiry calls, and for those months it trades right around the 200 moving average, so is it better to roll, sell, or keep doing it again, or doing it again to earn from the spike? Dude, that's what I'm talking about, right? There will be times where you make a buck or lose a buck, right? But you have to follow your entry and exit signals. There will be times where you make $1 and you get an exit signal. There will be times where you lose $1 and you get an exit signal, and bouncing back and forth. But then when it ticks off, when it actually runs, You've got to be there, just like every other entry signal in the past, where instead of making a buck or losing a buck, you might make $100 and you may not have to touch it for 60 days. But you'll never know if you don't take that signal. Now, one thing that Larry Hite was the very first $1 billion hedge fund manager and one of my mentors and one of the original market wizards. One thing that we talked about is there's no, if you have a plan and you don't follow that plan because you just lost on the last trade, you never had a plan to begin with. And always remember, any previous trade has absolutely no bearing on the current trade, right? Your trade that you may take on November 17th has absolutely nothing in common with the market participants, the price, the everything that happened on November 15th, okay? Everything in this trade is unique for this exact trade. Everything that happened in a previous trade has nothing to do with a future trade. They are completely separate events. Once you remember that, once you embody that, you can understand that I could lose 5 in a row and then on the 6th one have gazillionaire dollars come through. Or I might just make a buck. That's the important part of trading, is knowing the mental side of it. Vincent says, I use the wheel strategy, which is horrible. Listen, Vincent, I don't blame you because the wheel strategy sounds sexy AF. So sexy. And so many people push it. And I don't know why. It is a garbage strategy because he's just talking about this right here. I used the wheel strategy a few times and then only made $5 in each stock and missed a large upside on $30 a stock. Yeah. So the wheel strategy is basically, I think there's a couple different iterations, but you sell puts until the stock has gone down so much that you get a sign on those puts. Obviously a great start to begin with. You've lost so much money that it's fine. You'll just take the stock and then you'll sell calls against it. So then when the price actually goes up, you don't get to participate in the upside. You don't get to make up any of those losses because let's say it went down $10, you got assigned. You're selling calls $5 away. You don't get any more than that. That $10 is now off the table. You can only make the $5 back. So it's basically plan on losing. Once you lose, prepare to get ready to lose some more as it's in a downtrend. And then if it ever does start to be in an uptrend, prepare on losing more because you're never going to make any money because you have capped your gains. The wheel strategy is probably one of the worst option strategies out there. And I don't know why people love it. Probably because they're not outliers, but you know, what I don't know. Goody, thank you for not super chatting. Chris, can you make a video on how to paper trade using TradingView? Probably not, Goody, and it's nothing personal because we have a content strategy that I'm working on, and honestly, I don't know how to paper trade using TradingView. That's the real answer. It would actually take me time to figure out how to paper trade on TradingView and then do that. However, I'm sure there are lots of great content out there to help you with that. However, the 10, 20, 50 EMAs and bro. Moo feels too limited and complicated. In that case, if Moo doesn't feel right for you, there's lots of other brokers, and I don't particularly care which one you use, and it doesn't really matter which one you use, honestly. Just find one that works for you. I've bounced through many brokers, but you find one that works for you, and you probably won't have to change ever again. But yeah, that's there's so much to go along with that, Goody. Unfortunately, I'm not going to be able to do all that. However, if you watch my videos, the 2,500 videos in the past, I guarantee you I've gone through all of those many times. If you take a losing 80 delta call and get stopped out at your half ATR, which, okay, imagine you're in the trade, you've got a half ATR as your stop loss point, right? And so getting out there, do you still park the remaining capital in SGov? And if so, do you keep the earning interest there until the next clean entry? I assume is where he's going there. So yeah. I mean, if I get stopped out of my trades, right? If I get stopped out of my trades and I don't have plan ETF set up, then I would go to plan sit and cash and don't up, which is literally just sitting in SGov, and SGov pays you daily interest. So yeah, of course, right? If you're in a trade and it doesn't work and you don't have any other setups, then the trade to put it in is cash, right? It doesn't mean you need to go put it in the SPY if the SPY is not set up for you. Doesn't mean you need to go put it in anything. You need to put it in a risk-free place or as close to risk-free as possible until your setups actually come through. So speaking of setups, if you haven't put OVTLYR in the chat, you're going to miss out because we're going to do our bingo drawing right now. Now, we are going to do a second bingo video just after this, and everybody who has entered earlier gets to count again. But for now, Let's see who's going to win. Let's see who's going to be the first winner of the day. Let me pop up my email to April. Bingo winners. Who's our first winner of the day? It is Mr. B. Mr. Big. First winner of the day. Congratulations to Mr. B. Now, for everybody who's watching live, in order to claim your prize, it's super easy. Just shoot us an email, support@outlier.com, and we will take care of you. Let's see what Mr. B has won. Let's go to the spin the wheel random merch picker over here. Let's see what Mr. B has won. Mr. B has won a monkey hammered hat. Very cool. Monkey hammer hat. Outstanding. Congratulations to you, Mr. B. Let's see who our next bingo winner is. Let's see who our next winner is. The next winner is no way, the Ron Burgundy. I heard. I'm trying to think of PG things to say. The Spanish, if you know, you know, the Spanish meaning for Santiago is a whale's body part. Anyway, let's go over here to see what the Ron Burgundy has to say. He's stuck in a glass case of emotion. Let's see what Mr. Ron Burgundy wins. Stay classy, Ron Burgundy, because you just won a slingshot shirt with a small logo. All right. Ron Burgundy has won a slingshot shirt with a small logo. I like the specificity of that. Congratulations, Ron Burgundy, because 60% of the time it works 100% of the time. Outstanding. Thank you all so much for coming today. Listen, if you're ready to save time, make money, and start winning with less risk, click one of these two videos, and we'll talk soon.